I have been rereading the letters of Warren Buffett, the partnership letters, when he started as an investor at the age of 26, managing money for other people. These letters are better than the Berkshire Hathaway letters because he was younger, he was managing less money, and his returns were far superior compared to Berkshire Hathaway returns. And for me today, at the age that I am, I believe that these letters are going to help me better because I'm also trying to build my career as an investor, and he has already done it. So these letters are very helpful to me and hopefully will be helpful too. One interesting thing to note is that the average annual return of the partnership was 32%. You may say that today it is impossible to make 32% in the market because the market is more efficient today. It's hard to find these opportunities. But Warren Buffett tells us that if he was managing $1 million US today, he would be making 50% a year. So it is still possible to apply the principles of value investing that he learned from Benjamin Graham and David Dodd today to make that much returns in the market. So rereading these letters, I understood better how he was able to make these returns. And today we are going to talk about this. Actually, there was 1 year in which he made 72% returns in the stock market. To understand how, let's talk about the categories, how he categorizes his investments. At the time, there were 4 main investments. The first one was controls. These are the companies that he had full control of. For example, Berkshire Hathaway, when he invested in the company, gradually he had full control of the company. So it was a sort of activist investing. The second category, this is workout. This is arbitrage. This is something that I do. So if a company is being acquired and there is a spread on the acquisition price and the current price, you may make a profit by investing in the company. So this is workout. It's not just arbitrage, other types of special situations too. Why he was doing this is because if the market is crashing, these stocks normally would not crash that much. So you're able to have cash to buy other stocks. So that's why he was doing this. The third and fourth category, these are typical stock investments. He calls them generals. One is private owners generals and the other is undervalued generals. So private owner, this is the deep value investing. He used to call it like this. Why private owner? It's as if he's valuing the company as a private owner. So he's looking mostly at the balance sheet. So deep value investing, he was looking at liquidation price, mostly liquidation value of the company. And then we have the undervalued generals. These ones are the most common value investing we do today. It's not just about the balance sheet, it's also about estimating future cash flows of a company. It's not really about finding a company trading at 50% discount to its intrinsic value, but maybe only 30% discount to its intrinsic value, which is still a good investment. So we have these 3 or 4 categories, but the one that interests us the most is the generals, where he was investing in the stock market, buying and selling stocks. And in 1 year, 1968, he was able to have 72% returns on that part of the portfolio. So the portfolio returned about 50% that year, but the total returns was less because of the controls and also the workouts. So if you just look at the normal stock investing, he was able to make 72% in a year, which is something amazing. To be able to make 72% in a year just buying stocks that are trading below their intrinsic value and then selling them when they reach intrinsic value. So how was he able to achieve that? And that's also the reason why he closed the partnership later. It's in a letter that he wrote to the partners in 1968. In this letter, he's telling them why his investment strategy has to change. Before, he was aiming to beat the Dow Jones by 10% annually. But then he changed his strategy. He could not be that confident of making 10% returns superior to the Dow Jones anymore. And the reason is because he was not getting that many investment opportunities. It's mostly because his portfolio got so big. When he started the partnership, he had 105,000 US dollars he was managing. So it's not that much money. He could find great opportunities. But when you have reached millions of dollars, tens of millions of dollars you're managing, and at that time it made a lot of money. So of course it became harder for him to find great opportunities in the market, and his returns consequently would be smaller. It's the same thing that is happening today with Berkshire Hathaway. When you see that they have over 200 billion US dollars in cash and cash equivalents, is because they cannot find investment opportunities that will make the returns that they are expected. If let's say they invest in a company that has a market cap of only $1 billion, that company is undervalued. Yeah, yes, they can do this, but it's only 1 billion on nearly $1 trillion in assets, which doesn't mean anything for this large portfolio. So why bother making the investment? So Warren Buffett today, he has to look for these gigantic investments of at least $10 billion to have a good enough effect on the overall portfolio. At the time, he reached the same situation, of course, with less money, not $1 trillion. And that's why he had to change the rules of his partnership. Now, coming back to that letter, he said something very interesting there. That when he started, the ideas that he had were 110 to 1000% of the portfolio. And that's the reason why he was able to make so huge returns. What does he mean by this 110 to 1000% of the portfolio? Let's say today, one of the main issues I have in my portfolio, and that's because I'm not as smart as Warren Buffett, is I always say I have too much cash in my portfolio. I'm not finding the investments. That's one issue. And it's not just me. Many people find these issues. So let's say the required rate of return for any investment you're making is at least 15%. So every investment you're making, you're looking for a company trading at a discount of at least 15%. So if the company has an intrinsic value of $100, you're looking for a stock price of at least $85. Of course, you take a margin of safety. Let's say after taking the margin of safety and everything, you are willing to buy the stock at a 25% discount at $75 a share. And overall in your portfolio, let's say you're going to have 20 to 40 stocks. That's how many stocks Warren Buffett was investing in at one time in the partnership. It doesn't matter the quantity. So let's say even if you're more concentrated, it doesn't matter. So let's say 20 stocks. You're willing to invest in 20 stocks, but at least 25% discount from intrinsic value after taking the margin of safety. So if you find a stock that is undervalued, but the discount is only 20%, you cannot invest in that company. You find another one, 30%, you can invest in the company. So Warren Buffett, I don't know what was his numbers, he did not tell us, but he had so many great ideas at the time. So even if his discount required rate of return was 25%, he had so many that exceeded 25%. So many ideas. That's what he means by 110 to 1000%. So if he was looking for 20 investments with at least 25% discount, he had more than that. So he had more investment ideas than investments. And when you have more investment ideas than investment, the discount that you're looking for, 25%, it exceeds that automatically. So there are investments there that are going to have 50% discount from intrinsic value, 60% discount from intrinsic value. It's inevitable. This is mathematics. If you have so many great ideas, 1000% great ideas. So 1000% means he had 200 ideas, 200 great ideas with at least 25% discount. It's definitely going to be that some of them will have 40% discount. So he has his own internal hurdle rate. So even if technically he's looking for 25%, and I'm just making these numbers, he did not give us the numbers. Don't say that I said he was always looking for 25%. So even if, let's say, technically the minimal returns required was 15%, and then he takes a margin of safety, after that, the required rate of return for him is 25%. But since he has so many great ideas, he has his own hurdle rate now, maybe let's say 40%. So every investment he was making was at least 40% discount from the intrinsic value. And he was good at calculating the intrinsic value. He was good at estimating future earnings. He was good at managing the portfolio. That most of these investments did well. And when you are able to have 40% discount, let's say it takes 2 years to materialize. So let's say around 20% a year. Of course, you're going to beat the market by a big margin. So that was how Warren Buffett managed to do that. And this is something that we can do. Even today, how do we expand our investment ideas? How do we reach a point to have 110 to 1000% ideas compared to the size of our portfolio? We do research. We look for companies. It doesn't really matter how you do the research. There are different ways of doing research. Some people use screeners, others other types. I use multiple types to do research, but this is what investing is about. You have to keep doing the research. You have to keep looking for investments. This is how you are able to build such a big watch list. Your watch list should be bigger than your portfolio. You need to have so many good investments ideas that you are not able to invest in because in your portfolio you have much better ideas. One company that I have recently invested in that is trading at a discount to its intrinsic value is PayPal. So I will recommend you watch this video about PayPal. Have a nice day and goodbye.